So this is the trading floor at IG. We've got sales traders and premium client managers here. When a client calls through to speak to one of the dealers here.
Can I buy $500,000?
So what's going on here?
So this is a shares trade coming through from a client. Presumably it's too big for the desk to just take on.
You work at the offer?
He's going to be speaking to the client, getting an instruction from them, passing it on to the shares desk, who are then going to trade that in the market. If that order gets filled, obviously we pass it on to the client like that.
How come we're not hearing massive shouting all the time?
Because the majority of trading is happening automatically. If a client calls in with a small size trade, the dealers here can just book the trade into their account. If for the size of the market though it's a big trade, the share might only trade a few $100,000 a day, and somebody wants to buy a couple of $100,000, we might need to go and hedge that. So he's going to check with our shares dealers, pass the order over if we need to work it, and then get the client a fill.
So this screen here shows all the orders that are passing through our dealing system at the moment. All the white lines represent the automatically accepted trades. So in the past, there may have been some manual intervention where a dealer would have needed to have a look at a trade if it breached certain parameters and decide whether they want to take the trade or reject the trade. We've completely changed that now. We've built a new automated system that can automatically accept or reject all client-initiated trades. This will give our clients a much more consistent and efficient dealing experience.
We're under sort of obligations from the regulator. We need to provide best execution to our clients. That means giving them the best price at the time they choose to trade, whether that's offering multiple venues or pricing from multiple venues, multiple feed providers. In the case of FX, we've got 12 banks giving us FX pricing that we then give them the best price available from those 12. And at any time a client trades with us, that price can be referenced back to the underlying.
Here's an example of the price feeds that we receive from the interbank market. The way our price feeds work, we take we source prices from multiple banks. Our algorithm here is going to pick the best bid and the best offer in the market, and that is going to form the basis of our price. Depending on how tight that spread is in the market, we will have either a minimum spread or a normal spread, or maybe a variable spread on our FX pairs. So here are the price feeds that you can see for euro-dollar. As those prices move around, our price on our platform obviously changes at exactly the same time. So there's only a certain amount of risk that IG is prepared to take on. Obviously it depends on the currency. The major currencies we're prepared to take on a slightly larger amount of risk, and on the smaller currencies not so much. This is an example of what our exposure monitor looks like. So this gives the dealer a graphical representation of what IG's position is on each currency. On the left-hand side, we're short. On the right-hand side, we're long. As we reach our risk limit, we will then hedge the company's exposure. So if a client is selling the Canadian dollar, IG becomes long of the Canadian dollar until the point where we hit our limit, and then we are also selling the Canadian dollar. So we don't take on an unlimited amount of risk with our clients. We hedge the vast majority of the business.
Our exposure model is set up to ideally internalize all of IG's exposure. So we're looking to hedge our clients against one another. In an ideal world, client A is a buyer, client B is a seller. There's no exposure for IG. We can take the spread on both sides or the commission on both sides of the trade and not have to pay away hedging costs. In the event that all of our clients are, or a majority of our clients are trading in one direction, the same direction, we can go to the underlying market and trade the equivalent product to hedge our risk to the price of that market moving.
One of the key aspects to trading is to incorporate a stop loss onto your position. This helps to minimise the maximum potential loss on it. Nowadays, most global markets tend to trade 24 hours a day or near enough, which means if your stop is hit, it's very easy to refer to the underlying to see exactly why and when that happened.
We've got various alerts to make sure that the dealers are aware of any problems that we might be having, or just to make sure that our systems are functioning normally. So like any electronic system, there can be errors, there could be a price that comes from a bank that's erroneous or something like that. So we have various systems in place to protect our clients, to make sure that we don't have spikes in our contracts. If there is detected that there is an erratic move in a market, then that market might be downgraded, so taken offline, while the dealer here will investigate and see what the problem is and hopefully rectify it.